Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's January 24th, Wednesday here. We got a lot to go over today, and if you stay tuned, I'll give you an update on the comparison between the 2-year and the 10-year yields where they are at. So stay tuned. The last time we talked about was back in November, so that way you can kind of see how the spreads are edging closer and by how much. So stay tuned. But first off, we'll start with the economic calendar. We got existing home sales for the month of December. So back in November, we had 5.78 million existing home sales. Forecast is supposed to shrink a little bit to 5.7. It came a little bit disappointing at 5.57, but again, this is all due to extremely low levels. We are at basically on record one of the worst levels, or lowest levels we've really seen on record. We're down to about 3.2 months supply, where an average selling cycle is right around 6 months. So again, these are extremely low levels, and of course, we still got a lot of buyers out there. Now, the second item on the docket is the FHFA home price index for the month of November. So we had a nice big increase in the month of October at 0.6%. Forecast was supposed to be 0.3%. It came a little bit higher at 0.4%. Now, this brought our year over year to 6.5%, which is a nice, obviously a nice appreciation level there. So let's jump over to the headlines, and we got the stock market is up. Dow at one point was up so far this morning, which is obviously great news for those in the stock market. We still got Q4 earnings reports coming out there. Global yields are taking off this morning, which we'll kind of touch base on because they're anticipating there's a meeting or announcement tomorrow by the ECB, and they're preparing for a possibility. There's rumors going out around that they might pull the QE sooner than expected. So global yields are rising on a global level here, and we'll see how that affects our bonds as well as see what the yields are doing in a bit here. But that's what's going on right now. They're planning to meet tomorrow and give their announcement, and that's what's kind of driving the markets. They're kind of anticipating a possible surprise or whatnot from the QE. They might pull that sooner than expected. Now the markets are also kind of taken off by comments by Newton, Treasurer Newton. He basically said that he made comments regards to the how the weaker dollar is helpful to multinational corporations. Some basically our exports could improve, so that could help our multicultural or multinational corporations, making our cost of goods cheaper to other countries and create larger exports. Jamie Dimon of J.P. Morgan and Mr. Blankenfein from Goldman Sachs all basically said that the economy, the tax cuts kicking in, is going to basically create a boom for the economy. Now, it's still early; things are still kind of going in there, but we're seeing announcements going through so many different corporations, from like Disney of late, basically saying giving $1,000 bonuses to increasing the pay, all because of the tax cuts. They're all crediting the tax cuts for higher wages, higher bonuses and stuff, and some places are even going to be hiring more. Now, we did hear a few, obviously, on the other side where there's some people going to be closing. Some companies, of course, who've been struggling mostly on the retail side of things, like your Toys R Us, talking about closing stores. Walmart said at one point said they're going to close stores, but in any regards, for the most part, things are looking brighter for the economy. So again, we're at the early stages. We'll have to kind of wait and see how things move towards later, but that also could be helpful for housing if we can get increase our inventory levels, because obviously affordability will be getting there. So if people are making more money, that means they can afford, and affordability will increase. Today, we announced yesterday the World Economic Forum was going to be kicking in. President Trump was going to be heading over there today. The One of the things to look for is obviously he's a business person, so he could be making. We could get some announcements later on where he could be wheeling and dealing about different negotiations that could be going on over there while he's there. So let's watch and wait and see if anything translates from that. Let's take a look here at the bond market. As you can see, yesterday was looking pretty good. The yields were gave in, and we had some improvement yesterday. Now, as I mentioned, yields improved or jumped up based on the possible outcome of tomorrow's ECB. So it's pushed bonds right back below that first level of support, and obviously that's not good for us, which also translates to worse pricing. We're currently down about 22 basis points, and again, that translates for higher interest rates here. So on the other hand, here's the 10-year Treasury we talked about. We started even lower today and went right up. We're right at about 2.66, I think it is. 2.65 in this range. We're pushing up against this next level resistance, 2.665. And if we do get above that, right now we're about 2.65, but if we do get above this 2.665, the next level of support or resistance is right like 3.0. That's a lot of giveaway and room for rates to jump even further. So let's hope that this sticks, and hopefully this gets pushed on. Hopefully maybe tomorrow with the news that come in with ECB won't spook the markets as much, and maybe give back some of these yields. The gains in yields, and hopefully push it back down below this first level resistance, because this is definitely hurting bonds here, and at some point it could also hurt stocks as stocks become higher and higher, becomes more risky. This might be with the higher yields being presented, they might be content with those yields and move money from stock market into the Treasury as well. So as we had mentioned, let's take a look at the comparison of the 2-year and Treasury yields here. So as we mentioned back in November, we were up about 0.7%. So as you can see, we were probably right in this range here, of like 0.7% difference between the 2-year and the 10-year yield. So what's so important about this? When the Fed is raising rates, it affects the 2-year yield, and that rises up. The 10-year yield has been pretty steady and mechanic in this sideways level here for a while, and with that quickly shortening, that gap, the difference between the gaps, it makes a big difference to lenders, primarily because once we get to a flattened yield curve, they don't want to be lending money out. They get real restrictive, and things get to be the credit becomes a lot tighter. And then when we go to a negative, so when the 2-year goes above the 10-year, that becomes like a negative yield curve, which basically forces us into a recession area. So this is why this is kind of important. Right now, with the sudden increase, we were down to about 0.3% earlier, even like this 0.3% or 5.3% difference. Now we've kind of spiked up to 0.58 of late because of that push in the global yields has kind of helped us a little bit. But we're still in that same level. We're much lower, and the Fed is expected to raise rates at least 3 times, maybe even 4 times this year, which could, again, if you've heard me speak, I've talked about possibility of watching towards the end of the year. This could be, a flat yield curve or perhaps a negative yield curve by the end of the year. So let's wait. But just want to give you this update as to where we are and explanation. All right, guys, that wraps it up. Things rates are a little worse today. If you guys want to get more updates, just come over to Twitter. You can find me at Mike Bjork, and I'll be posting throughout the day. You guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.